Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
And it is Saturday morning once again. Welcome back for another weekly market recap. Now, we are developing a very strange tendency, right? I usually record these videos early in the morning on a Saturday for me, which basically would be kind of like around 3, maybe 4 a.m. Eastern time, and even earlier than that if you consider the Pacific Coast in the US. So naturally, many times I finish recording, America wakes up, and President Trump goes on with something new. And, we've seen it with, the Venezuela news. And now we've seen it with what came out about Greenland, right? I recorded a video, no thoughts about Greenland. And throughout the weekend, we have seen this escalation in between the United States and the EU over, the takeover or the acquisition of Greenland. So the bottom line is, we started to see the tariffs talk coming back. So, the president announcing 10% tariffs on those 10 EU countries which were opposing the acquisition. And of course, the EU immediately responded with, if you do that, we are going to implement countermeasures like tariffs on our own and, the commercial bazooka, and then, the anti-coercion instrument. Which, as far as I'm concerned, that's not really a tool you can use unless you want to go for the nuclear option, which would absolutely guarantee mutual destruction to both systems. Plus, I don't really understand the logic of, threatening to, we are going to sell off all your US treasuries. Yeah, go ahead with it. Yeah, they're going to take the hit massively and you're going to be fucked. You as a EU, right? So, I don't know, but that's where we are. And again, we have discussing this many times. It's going to be a world very different from the one we were accustomed before. So, beside all of that, there are many things that you can see coming. Like, another thing, personally, I wasn't expecting to spend the night at the hospital on a Tuesday after fainting right after dinner. So it's nothing bad. It's nothing atrocious. It was, the doctor called it, a vasovagal syncope, if that's the term. So, it's not really incredible. And there is no treatment. It just comes and goes. So you need to check your habits, maybe taking a bit more care of yourself. But other than that, I'm completely fine. For those wondering, don't worry. It's all fine, right? Now, all of that being said, let's jump into what was the economic calendar for the week. We started out with ADP employment change, which, it came in positive. It looks like it's kind of topping out, and I think that's completely understandable. If you look at the date, it started to go up in November, and then it peaked right around the middle of the end of December. So I think there is a lot of seasonality there, with the festivities. You might see a little bit of a spree, especially in temporary or part-time jobs throughout the festivity. And then, it fades away a little bit when we get into the new year. So I don't think there's nothing new in here. And, we'll see how it is. It is going to be shaped up in the future. But for now, I'm not seeing any anomalies. Now, let's have a look at what was one of the biggest news for the week, which was GDP. Now, it came in at 4.4, revised upwardly, but no, it was coming from what? 4.3. So, a tiny revision to the upside, but, pretty good number. Now, I'm not going to spend a lot of time on GDP. I would just say that although, the headline number seems fantastic, right? There is more to it, all right? And, if you want to have a kind of a tiny deeper look into it, I would point you out to a video that just came out because I watched it the other night. So probably it was recorded on the day the data came out, and it was uploaded just yesterday, I think. So it's by George Gammon. You can check his channel. The one where he does all the whiteboards, and it's nice analysis about what this figure actually means or what could mean. And I do agree on kind of the majority of it. So very interesting if you want to check it out. For me, I would just say, yeah, it's a good number, although I think a lot of that has been boosted by, first of all, as we discussed in the past, these, so net exports. Now, you might, give credit to President Trump for what he did with tariffs, with this new policy. A lot of that, if you check, the pink shaded area, which, as you can see, in 2025, Q1 was negative. And then, starting in April, tariffs were implemented, and you see Q2, Q3, that pink shaded area goes up and massively. So, if you think about how GDP formula works, if you increase net exports, that's going to be a very positive factor for the overall GDP. So that would be one thing. Although, I also do think that precious metals, especially gold, they played a massive role. But it's nothing new. I've been talking about this in the past. So, gold goes up in price. There are more exports of gold out of the US into the rest of the world because the rest of the world demanded, or, maybe they were storing their gold in the US and now they need it back. So, it might be something like it. And what we got, which, it's positive, but it could be scary in the long term for many different folks. And that would be this one. So the labor productivity, which is going up, right? Now, again, it's just 2 data set, and it's not like it's completely shading out these previous numbers in 2023. But, the doubt now, or the scary part, might be what they say here. Has the AI productivity boom arrived? Because you've seen many different companies starting to implement new technologies and therefore boosting their productivity. By doing so, they can avoid or get rid of what? The human component. And what's the most, negative side of the balance sheet when it comes down to a company? Labor cost. So, if you can avoid labor cost, but maintaining or increasing the level of productivity, what's going to happen to the overall net economic output? It's going to go up. So that would lines up with what we are seeing in GDP figures, right? So that's all I have to say about GDP. Again, if you want to have a little bit more of an in-depth discussion or some potential doubts, just check out George Gammon, all right? As for the jobless claims, nothing new. They kept on doing whatever they were doing before, so coming down for the headline. Same thing for, obviously, the 4-week average. And, again, the continuing jobless claims, they're still at a level which it's not, incredible or incredibly positive in my view, but at least they're not going up even more. So, let's call it a win, right? It's not deteriorating further, right? And what else? We got PCE, which came in at 2.8, which, it's kind of in line with the expectations, of course, and it's not massively deviated from the previous reads of the last, call it 4 to 6 months. So, inflation, it's not coming down massively, but it's not accelerating to the upside massively as well. So, did I say massively? Slippery tongue. I'm going to repeat. Didn't go up massively, didn't come down massively, right? So, stable enough. Which, what else? Brings us to personal income. It's still positive, but as you can see, it's slowing down a bit. And personal spending, again, kind of positive. So, staying relatively stable at these levels. But, after the peak in December 2024, it looks like it's fading slowly, but it's fading. Now, all of that, if you combine all of that, so, what do you have? GDP going up, productivity going up, and yet, as we've seen from the latest NFP, the data on the unemployment, and, in this case, personal income, personal spending, it gives you a situation which is actually described by the term K-shaped economy. Whereas normal people, the average Joes and Janes, they are struggling a little bit with all you see in the economy, right? Jobs opportunities are lackluster, and inflation, it's still kind of a problem because although it has been tamed a lot, but those prices are still very, very high compared to where they were, let's say, in 2019. And, although wages, they grew, but maybe not enough to offset the spike in inflation that we had. And on the other side, you have companies which are massively expanding capex. So, a lot of money being poured in the real economy in order to build up AI infrastructures. So there are those which are laughing, which are basically those holding assets, right? Mainly, it could be the S&P, it could be precious metals. And there are those which are crying because they don't own assets and they have to rely on their simple paycheck, which it's getting harder by the day. All of these brings us to see the break-even signaling a potential resurrection of inflation tendency, all right? GDP now, which is now posting at 5.4%, but again, always remember how do they calculate the entire thing here, right? Probably it's not going to be that high. It might be, at this point, it might be higher than what I was anticipating, right? Do you remember my target for the final revisions for the entirety of the year was 2%, maybe 2.2, 2.3. It might be, at this point, that at the end of the day, unless we have a huge surprise in Q4, that we are going to exceed that target. But, again, up until we don't see it, my quote-unquote projections would still be the same. All of these, right? So inflation, which is not cooling off any farther, and potentially reaccelerating, as shown by the break-evens. GDP, which is bombastic at this point, right? That's the best economy ever. We are actually managing to build up better, bigger, and stronger than ever before. It could bring the Fed to actually leave rates unchanged at the next FOMC meeting next week on Wednesday, which should be the 28th, I think. Yeah. So in this case, I was thinking throughout the month, I was looking at these bars, these blue bars, and I was thinking that at a point, these 95% would have come down a notch. But, with PCE coming out, with GDP data, it kept on being where it was. So I do think at this point, the Fed might look at the whole and saying, well, PCE relatively stable, GDP looks like it's going up and up and up. There is no way to stop it. And since they always come at it with some sort of a fear of inflationary tendency, I think they might decide to, first of all, don't take the risk, right, of cutting rates even more, and then seeing inflation actually, showing up again, because at that point it would be another policy mistake, all right? And on the other hand, they can still say, well, you know what, we can make a pause here in the cutting cycle. And then if we see things deteriorating even more, well, we can always cut all of a sudden another 50 basis points, right? So, the balance of risk for them would suggest something like it. The prudent path for them might be this one. Also because, again, as we have said in the past, they tend, or at least, since when Powell is in, they tend to not want to disappoint the market. So if the markets are showing and manifesting some sort of expectation, they try to not spook it. So it might be we don't see any further cuts, although I would expect a little bit of an hawkish tone throughout the press conference. We will see. I mean, it's just 4 or 5 days away at this point. But still, all of these conflicts with what we are seeing from the real-time data. So, PCE, as for trueflation, is not 2.7 or 2.8, but 1.4. And CPI, it's not 2.7, but it is actually 1.2. So, there is a little bit of a conflicting narrative there, and we'll see who's going to win at the end of the day, right? Now, of course, credit spreads, they are on the floor. Nothing is changing in here, so nothing new. And why do I have this tab over here? What's that? Oh, well, it's inconsequential, pretty much. The Michigan Consumer Confidence, which, if you look over the last 10 years, yeah, it's really low, right? But again, I think that that's still another component that you could include in the K-shape economy argument. Like, it tells you that consumers are actually particularly negative because they are getting the, how do you call it? The low end of the stick when it comes down to the, imagine the K, you're getting the lower part of the K, right? So there are those which are getting screwed by it, right? So that would be it for the econ calendar this week, and let's jump into the charts. Now, before getting in, a little bit of a preface. A lot of stuff that we were talking about last week, they have proven to be massively wrong, and the market went completely the other direction. Not all of them, but a few, the ones which did, they did it massively, all right? I think it would be very stupid for me to say, well, that would have never happened if it wasn't for Greenland, for tariff stocks, for what was discussed in Davos and all the rest. You know what? Just leave it out of the door. Sometimes you just simply get it wrong, and you need to have the intellectual honesty to say, well, I had a bias. I was expecting these happening over this other one. Guess what? I was wrong. And the market went the opposite direction compared to what I was expecting, right? I think, again, that's just a simple step that you have to do in order to become a better investor, a better trader. Now, of course, this is just forecasting. We didn't open any type of positions, or at least I didn't, right? Based on that. But, it just to show that sometimes you can get it wrong, and accept that you were wrong, cut out your losses early, and move on. Right? It's normal to be wrong, right? Now, let's have a look. So, first of all, DXY, all right? Now, last week, it was looking like it was healthy. It was going up. We had an impulsive move higher, bounced off of a level which was flipped, and it was going higher and higher. Now, of course, right out of the gates this week, it came back down. We found, some sort of preliminary support at this lower area, which was still kind of in the cards for this type of pullback. So we kind of stalled a little bit there. Very anemic bounce, and then we kept on going massively down, as you can see. So, we broke this key swing right here, and we got back into this macro level. That would be basically the midpoint of this long range that we were in for quite a few months, I think, yeah? And basically the same area which supported or which acted as a launch pad for this swing to the upside. So that would be the area, basically. So we're still here. Problem is, we are getting back into here after already tapping it before going up, kinda getting back near there and front running it. Then another bounce, which was faded. So, when it gets back into it now, how much would you think it could hold? So that puts the DXY in a very precarious situation at this point. Now, again, if you want to add a little bit of a news or fundamental component or driver into it, you might say, well, the same way it was crashed by what was going on this week, the same way it could be lifted up if something, on the opposite tone may come up. Maybe, who knows? But as you've seen, sometimes things just happen, right? So it would be pointless now to say, well, but now if Europe says this, or if the president says this, forget it. Just let the price be your guidance, even when it shows you that you're wrong, right? So consequentially, with this down move in the DXY, we have seen stuff like the euro going massively higher. I was expecting it to come back around the 155 level. It didn't, because obviously it shooted up beginning of the week and it never looked back. If not, that was interesting nonetheless. But this tiny little pullback in here. And what did we use as support? Well, this area, which again was highlighted as support when, broken and flipped resistance as it was going down. And then again, it acted as a nice pivot once again, once we broke back above it and we closed back above it. Look at that, right? The what was that? GBP, same, straight up. Same type of pullback of the euro, but much more, contained. It's not really a pullback. It's just, market going up, sideways a little bit, and then up again. So up move, price pause, up again, and impulsively, right? Very, very thick candles, a lot of body, no wicks on both sides. So that's usually conviction on the side of the buyers in this case. What else? Oh, the Canadian dollar, which at the end of the day, although it was a bit choppy for a week or so, but again, on the back of all the others, it managed to hold this level that we were looking at and push again higher. And at this point, I think, these high might be targeted unless we are going to be faded in here and we're going to establish probably a range like it was in here. But other than that, these targets should at least be targeted. Now, does it mean that just because something should be targeted, it's going to be actually hit? Well, we'll see, right? It's no guarantee, but that would look like the natural progression for now. The Swiss franc is still going up in these. At this point, you can clearly see the channel. It's going up in these upward channel, right? Rising channel, right? But the interesting one was the Japanese yen, which all of a sudden printed this massively bullish candle. Now, of course, you see it as it is bearish because I inverted the chart, right? The dollar is the numerator in here, but that is essentially the Japanese yen coming back up. Now, again, if you remember back in the past, we were discussing the long-term implications of the yen reapproaching the 2024 lows, right? And again, there was another major low which was put in January 2025. So it looks like, again, getting back to that conversation, the area which is basically beyond 160 or the 160 area, call it, that's where the BOJ is trying to draw the line in the sand, right? We are fine with the yen being devalued, right? But, that's the limit. If it gets back down to there, we're going to intervene. And, although the BOJ actually left rates untouched at the last meeting, so they didn't raise rates once again, it's still around, 0.75, I think. They intervened, I think, in the FX markets. And it's quite curious. I need a bigger chart for this. But if you look at the USD JPY pair, right, which is the same that we had in that lower quadrant, let me invert this. All right. If you go on to the 1 minute chart, you see that right after they got their press conference for the BOJ, you've seen these in the FX market. Now, again, it looks to me like that was some sort of a rate check. So, we announce rates, then we say that at this point we might do or try to do something to, intervene in the FX market to, safeguard our own currency. That's what you see on the 1 minute, right? And then after that, the market got back to be quiet for a little while and it just shoot it up. So I think that was some sort of, when you have to do some sort of, it could be, just call it performance, right? You make a lot of checks, right? You try it again, and then you make the final tryout in order to make sure that you're ready for it before going public, right? So I think that's the same thing they did in here, right? They tested the waters, right? They tapped their finger into the water of the FX market, and then they said, well, yeah, it looks like there is enough liquidity, right, which will allow us to intervene, that's for sure. But at the same time, if we are going to intervene, we are not going to move the yen of 10, 15% in a day, right? at the end of the day, the move was quite substantial. I mean, 1.6%, right, in a day for a currency, it's a decent move, right? The yen is particularly volatile, so maybe, you would need to adjust the scale, but, it is a pretty good move to the upside. If you look in the past, what type of moves to the upside we were looking at, right? One which could be similar is this one. And I think, again, check the dates, July 31st, I think there was some sort of an intervention, or at least, the internet was talking about the BOJ being, potentially involved in establishing a new floor for the yen. As you can see, after that, we've seen for a few weeks, the yen was relatively stable before eventually collapsing once again. So, I think the reason why they do perform this check ahead of times, it's because they don't want to see the yen going up like this, maybe 4 or 5% in a day, right? Because at that point, they would cause disruption in the entirety of the FX market. And obviously, since we still have the yen carry trade looming, or at least, the yen carry trade unwind looming, they don't want to provoke something like that. And quite frankly, I think that when they do these type of interventions, I think they give it a call to Washington and say, you know what, we are about to go ahead with this. Are you okay with this? Or are you ready in case things go south to support the rest of the market, which, I don't know, swaps or, coordinated interventions and all the rest. I think, major central banks, or at least those which are in the same block of alliances, right? So it could be Bank of Japan, Bank of England, the Fed, the ECB. When they do these things, at least they use the professional courtesy to give a warning to the others and potentially trying to get in line and trying to go for a coordinated action, which is not going to disrupt markets too much, right? So that's what I would say about the yen. There's been a lot about Japan, not only as for the yen, but also for the JGBs. Now, it looks like they are performing a tapering of their balance sheet, the same as we've seen with the Fed, although, in this case, it's like they are doing it on a much larger scale, and they intend, at least those are the intentions, we'll see, they intend to do it for quite a bit of more time, because they would like to get back to a normalized situation where all the QE, the yield curve control that they implemented for the last 20, 30 years, it's going to be reversed. Now, if you want my, long story short version of these, they're never going to do it. Like, yeah, they might say we're going to hike rates for now, we're going to try to taper. As soon as the next wave of shit will hit the fan, they're going to get back to where they were. So, I think, QE and all these type of monetary interventions and policies, those are like, it's the genie is out of the bottle and you can't put it back in, because at that point, you're going to risk your political capital. If you got disruptions in markets which are going to impact the average Joes and Janes, which coincidentally are those which are voting, if you want to keep your seat, you're going to do something if they demand it. Otherwise, you're going to be voted out. So, I think there is no coming back. It is for Japan, it is for the US, it is for Europe. When you go down that path, I think it's extremely, extremely difficult to come back, because you would need to get to the point where the pain of doing the same again and again and again, it's much larger than the pain of trying to change. And I don't think we're there yet. I mean, looking again, no, we are getting political here. I don't want that. But look at what people are voting for. Do you think that's the attitude of people which would like to see a genuine change? No, because genuine change implies what? Pain in the short term. And nobody wants to feel the pain. So they're going to keep on moaning year after year, decade after decade, but they're never going to try to change it. Because at the end of the day, we are fucking lazy and stupid people all across the globe. It might be a little bit pessimistic, but, I think it's not far from the truth, all right? Then what? We have seen that even liquidity in the JGB market, it's particularly deteriorated. And again, think about who is really trading these treasuries or you know these assets. Nobody really, right? I mean, the majority of them are held by the central bank. The rest is held domestically. And even I was reading, even pension funds actually started to unload a little bit of them. So, you know, as for the rest, nobody actually trades them. I mean, sure, the foreigners might take positions in, you know, the benchmark, like the 10-year, or maybe the short-term JGBs because they need them for liquidity, collateral transformations, or they need it for some form of a carry one way or the other. But other than that, why would you really want to be involved in these type of things? So, you know, I think it's natural that they are very illiquid. And again, that could be another problem, right? And finally, as you can see, you know, again, as for the yen, right before Friday, right, there was a good enough short position against the yen. So, you know, it might also be that at the end of the day, what the Bank of Japan did, right, call it, or, you know, supposedly it was an intervention. They weren't public about it. They usually do it, you know, silently and try to keep it quiet. And you kind of grasp it by the movements that you see in the markets. But, you know, they don't announce an intervention, obviously. I think, you know, they waited for this metric right here to be particularly unbalanced in favor of the sellers. So they wanted to see a lot of speculative bearish bets on the yen because they knew that at the point they just need to tip it a little bit and maybe starting buying a little bit, bringing price high enough that all those shorts would have closed down, bailed on the positions, and they would have caused what? A massive tide wave of buying, right? The shorts closing, right? So I think, you know, if they really intervened, they picked a very nice timing for it, right? So again, we'll see how this is going to develop. At the end of the day, if you zoom out, I mean, is it substantially improving? Even if you draw a trend line like this, right? You can see that we are still kind of going down overall. Now, sure, in the very short term, you might say, well, but we reclaimed this level, which was resistance. We reclaimed this point of release. Yeah, sure. I think still the big level would be this one at 154, right? If you really want to have a change in the overall tone of this. But even if that's the final destination, I think they would much prefer to do it slowly. So, you know, maybe it comes back down now, it goes up again, it comes back down, goes up again, and so on and so forth. Nobody, not even the Bank of Japan, would like the yen to do this, right? Because if that happens, they're gonna cause problem to anyone, and they are gonna have, you know, Christine Lagarde, Jerome Powell, everyone on the phone saying, what the fuck are you Japs doing? You know, we didn't get the memo of it. Are you fucking crazy? So I think, yeah, that they will try to do it slowly enough. Now, as for the rest, we've seen, well, you know, these two on the up, in the up left corner and the up central section of the screen, they kept on going higher. There's nothing new. The ruble, it looks like finally made up his mind, breaking out of this consolidation, this dealing range right here, going to the upside. And, you know, that could be good. We have the spike after the uptrend, a pullback, reaccumulation, and it looks like maybe it's ready to keep on going higher. The Indian rupee, again, no matter, everything is up against the dollar, right? Like checking the DXY, although, again, DXY, it's majorly weighted out against the euro, the yen, okay, but pretty much all the other majors are up against the dollar, not the rupee. So, you know, the Indian rupee, it's still, you in a bad shape, and it doesn't look like it's slowing down, right? Brazilian real, again, it took a while, as you can see, but what we said, well, we get back into this level, we have overhead resistance, and we know that the probability of filling the external gap is a little bit higher than filling the internal one, which would be this one right here. But, you know, if we can maintain the level now, probably it should trade higher. And again, took maybe 2 weeks. And again, you might say it's news driven, yada, yada. Yeah, but at the end of the day, it did it. Not only that, but we reclaimed these upper level right here. So, you know, there was an apex in here, was tested back in, which developed on the way down a point of release, which was traded through cleanly. So kind of like this level right here, you would expect a little bit of a support resistance flip here if the momentum of the market to the upside is maintained. All right. Another one which I took wrong was the Australian dollar, because I remember I was saying, well, you know, yeah, we are still holding this level, but you know, it looks like we spiked to the upside and we are getting stable around the low side of the range. That's usually weakness, so don't be surprised if you see a little bit of a spike to the downside and all that type of logic. Well, none of that held. Was completely negated again, starting on Monday, and it just went up, right? No pullback, no looking back, up and up, straight up. So again, just to show that sometimes those things can happen, right? Don't get me wrong, you know, at the end of the day, yeah, sure, it wasn't looking like it was about to go up like this immediately, but I also said, well, maybe, you know, a little bit of a spike down, picking up new inventories and then trying again. So, I mean, I wasn't expecting to, you know, the Australian dollar to plunge and basically getting back to the lows, right? But, you know, still, if you, let's say you are a short-term trader or an intraday trader, if you were betting on a down move intraday or intra-week, well, you had another thing coming. So in that case, you could still say you were wrong, although, you know, your long-term bias was up, right? But again, it depends on the time horizon that you stick on it, right? Speaking about another one which I got wrong was Bitcoin. You know, I mean, although it was coming up very orderly, very efficiently, we were expecting another type of support and resistance flip. And the logic was, well, you know, up until the point this area right here can hold, we should see from here on out higher prices. We might get back into it, holding it and going up. And again, the opposite happened. We immediately break down, as you can see in here, a clean break. No, we didn't even stutter a lot. There was no price pause around it. Like it was, you know, slowly eroded or depleted. It just shattered through it. And not only that, but we breached through the previous level of support and resistance flip, which was the catalyst for this move up. And now we're living below it. The good thing is, if you want to give it some sort of a last hope, if you rewind time and you get back to those moments where we were basically in here, right? And we were saying, look, we are holding this level. And even if we, you know, very quickly breach below it, we still have this one, which could be used as a bouncing area and maintaining the overall structure intact, right? High, 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 and all the rest, okay? So it looks like we basically found a little bit of a support in that area, secondary area, so to speak. So far, the reaction is pretty lackluster. I mean, you're not seeing like this type of reaction right here, or, you know, this type of reaction, although, you know, on the flip side of things, this is a resistance, but, you know, this type of reaction from a level or an area, okay? In this case, we are seeing it going sideways, a lot of dodges, which, you know, it's okay that we are not having immediate follow through to the downside, so there is still the hope that same as we did in here, right? Bit of choppiness and then up. We might try to be choppy a little bit here and potentially starting to build back up and see if we can, you know, kind of do the same. But the problem for me now is that it's acting very weak. And, we're going to talk about it later, but even stocks after the initial spook, they came back up, right? And I think, and I know many crypto enthusiasts might hate me for that, but I think that the speculative rush simply moved on to other things. Now, I know you might say, yeah, but if you zoom out, it's still good. It's still going up long term. Why would I completely abandon ship? Yeah, I'm not saying you should, right? I'm just saying that these type of momentum that we were looking at in here, or maybe in here, right? Or in here where, where ATFs were announced and launched, it was driven a lot by narratives, right? I mean, do you remember like the crypto treasuries, like or companies like MicroStrategy, right? And then what do we have? President Trump is he's back in the office, and he just announced that he's going to go to establish a strategic Bitcoin reserve. And everyone was saying, hey, oh, well, this is the US government is bidding, so there is an infinite bid now. Yeah, I mean, but even there, they never actually bought Bitcoin in the open market. They seized what they could seize, right? So was it about to bring in additional demand, right? And again, once a narrative fades, it might take a bit of time to bring it back. So again, for now, Bitcoin is underperforming a lot of different stuff. It is underperforming the equity market, not only in the US, but, have you checked what the other markets, equity markets around the globe are doing? I mean, there are a lot which are just shooting higher. Even emerging markets, China, Israel. Did you check Israel? The Israeli stock market. And, again, most recently, again, because of what happened in Venezuela, the Venezuelan stock index, or, precious metals, but basically everything is going up massively, but not Bitcoin. So again, this is why I think that a lot of what was driven this massively and huge run up, you can talk about fundamentals all you want. I think at the end of the day, it's liquidity, is market dynamics, and is sentiment. Because at the end of the day, what moves markets? Yeah, sure, what? An imbalance in between buyers and sellers. All right, how do you create that imbalance? Well, you need to have more people, keyword, willing to buy than those willing to sell in order to see, the market going up. So again, that imbalance in actual facts, it is generated and predicated upon a sentiment, willingness, intention, desire, wish. If you don't have that, you're not going to get the other part, right? And it looks to me like since the narrative faded a little bit, people just temporarily, I'm not saying forever, again, don't start to tell me, oh, so you're perma-bearish on Bitcoin. Look, I might be not, but this shit just coming down since last October, right? So at the same time, I can't be bullish for now, right? And I think that's it. I think, if you check metals, they're going up. So all those people which were trying to chase this market higher and higher, or playing speculative and leveraged positions into it, they're just saying, you know what? Why am I keep on losing time with these when I can keep on buying, 2 5x leveraged ETFs on gold and silver now, and it's going up every single week? So I think a lot of that is the momentum. Momentum can benefit an asset a lot, but it's kind of like trust. When you lose it, it takes a while to build it back, right? So as for now, I would say it's much more logical to stay short-term bearish on this asset and see what happens here, right? I'm going to be short-term bearish up until the point we, first of all, reclaim this area and we can at least get back into a ranging behavior in here. And I might say, okay, at this point, it was a major scare. I'm bullish again. If we tackle this previous area and we reclaim it, right? And we keep on trading above it, retesting it, confirming it as support, and, you know, trying to push higher. So either these or potentially, you know, at a lower level, preliminarily, these. All the rest, up until the point we are here, we are stuck in here. It might go sideways a little bit, but, you know, as soon as you see these low and these lows giving in, you see the market going like this. I think at that point, the potential for a quick shot to this low, that would be on the table, right? So as for now, I wouldn't take any risks in Bitcoin if I was to trade it, right? Just treating it like another normal chart. Oil was interesting now that we keep moving ahead. So there was that doubt about, yeah, but was it just geopolitical risk, or do we really have some sort of, you know, something really cooking in here? And it looks like the market for now, it's telling us that maybe we could have something cooking up, because, you know, we said we finally broke out of a structural high, key high, right? And we came back. Sure, there was a lot of volatility because, you know, the situation in Iran, and, you know, an aircraft carrier from the United States moving from the Pacific into the Persian Gulf. Yeah, but, you know, we came back, never really touched what could have been the support area right here. We just front ran it. And although, you know, a bit choppy, a bit messy, but we kept on going higher. So you can see how the structure changed, like, lower lows, lower highs, lower lows, lower highs. And again, what we were saying last week, higher low, higher high, right? What you need now is another higher low. And again, I think, again, if you're bullish oil, the next level for this progression would be finally getting above this level right here. So maybe, even if it keeps on being choppy, right? Let's say it pulls back, it comes back up, it pulls back, right? But eventually breaching it, retesting it, and maintaining above it. Now again, maybe it won't be as sharp as a reclaim and retest and go. It could be something like what we have seen in here, right? So it come up, back down. It spends kind of like a week with these very weaky price action, but then it finally moves to the upside. So if you want to be bullish, I would say that, you know, that would be kind of like the natural progression that I would like to see. And again, remember, I still think that fundamentally there is not a lot which would sustain oil prices going up, for long enough, unless what we are looking at in the data, back to the beginning of the video, as for GDP, productivity, right? Unless that is, something which turns out to be true. And at the end of the day, we are going to have a reflation, as we were discussing last week. And so, if you have reflation, you should have economic growth. And energy, since energy is the economy, should reflect that. And you should see oil going up. It's not only oil. I think, let me see if I got it in the watch list. It should be this one. Yeah, even nat gas came up. Although, I must say that, it's already down here again. Okay. Now, well, look, maybe zooming out on a weekly time frame, right? Clearly, the trend compared to 2022, it looks like it's starting back to go like higher lows, higher highs overall, right? On a weekly time frame. Now, funny thing at this point, if you're just looking at this recent price action, it's because the US is about to get hit, or they're getting hit right now. I think it was forecasted in between Friday night and Saturday. So I think they're going to get hit by some sort of a glacial storm or but anyway, very low temperatures, right? So obviously, since a lot of nat gas is used by, for simply, heating up the houses of Americans, if you have something like that coming, well, price is going to go up because they forecast a much bigger demand. And, now we are seeing that meme by which you want to trade nat gas? Well, just follow the weather forecast and you'll know where it's going, which, again, it's just a meme. Obviously, you don't trade based on the weather forecast. It would be the same as trading based on what? What are you, Sagittarius and Aquarius? Oh, that's your best week ever because Jupiter is aligning with Mercury and they are in the same spot relative to the sun and all that. Fuck it. I mean, I know there are people which are trading based on the moons, especially on Bitcoin, which again, it's strangely, it's not bad at least for formulating your bias, but, enough joking, right? So let's have a look instead at what precious metals. So let's have a look at gold. I mean, how do you comment that? I think last week we just said, look, we had this kind of a backfill of these candle right here. So there was, this candle to the upside, which was a little bit inefficient, as you can see. Tested back into it, basically flipped the previous top or apex. And the only thing was, well, look, you want to see continuation from here? If you see continuation from here, this is going to run. And again, it looks like, I don't know, it looks to me like it ran, right? So, yeah, I mean, we are approaching 5,000 at this point. I don't know if the futures already touched it. Slight front run. Guess what? Around what? 4,992. But again, these big figures, sometimes they are front run a little bit. They are either front run or overshoot, but there's nothing to say about gold if not that it keeps on being massively bullish. Now, the only one thing, which again, I'm gonna say it again before I go ahead with the rest, doesn't mean that the top is in, right? But the only one thing would be, as we have seen in the past, on different magnitudes, but when the market goes up impulsively, it is always prone to potential sharp and quick pullbacks. That doesn't mean the trend will reverse. That doesn't mean that you need to sell all your gold now. But if you're playing with it intraday and with margins, just pay attention, right? And, a few examples. One could be this one. See, it goes up and immediately rebalance down. Another one could be this one. Goes up, rebalances down. Goes up, rebalances down. So, goes up. Could it rebalance a little bit of this up move? Maybe. So, just pay attention. On the flip side of things, if it is a risk for those which are playing it intraday, could also be, let's say it happens, we don't know, but if it happens, could also be another opportunity to add to your positions if you're playing it for the long term, right? So again, there are always two sides because obviously where there is risk, there's also opportunity, right? Now, the rest of the metals, they kept on doing the same. I'm looking at the 4-hour here just because, as in the past, I like to highlight how the market is building up a base, is building up the volumes, and then auctioning price to a new area to the upside. And doing the same, building up volumes, building up bases, or in this case, they would be shelves. But anyway, you get the point. It's building up the foundation for the next move. And again, this is a very constructive behavior. Now, sure, there are a few spots where there might be some points of weaknesses or vulnerabilities, like, for instance, in silver, it could be this area right here where we didn't really build up a lot. Although you know, it is also true that in order for it to become actionable in terms of, you know, would I target that area with a short if I am expecting the market to get back into it? Yeah, well, the problem is that first, you would need silver to top out, right? Breaking this area right in here, then breaking the immediately following area below, and then you can start to think about rebalancing this area right here. So, yeah, I mean, sure, admittedly, it is a weak area where we didn't build a lot to the way up, but we built up at an even higher level. So, you know, and then we kept on going higher. So again, not even the index rebalance managed to throw a dent in this massive upside momentum that we are looking at as for metals, right? I'm not going to spend time with all the rest because they're doing pretty much the same. Copper, again, it's kind of like the weaker one of the pack at this moment, but it's still in a massive uptrend at the end of the day. Yeah, right? So again, don't be bearish metals for now. Sure, just be mindful that at a point they will top out, but we don't pick tops and bottoms. We wait for them to be confirmed by the market, right? So for now, the narrative of metals, whatever it is, I mean, you know, you know it, that I don't trust that. I don't believe that. Like, for instance, I don't believe in the debasement trade because there is no debasement, right? There is inflation. That's one thing. That's not debasement. And although you might think that's semantic, there will be one point in the future when that semantic is going to count a lot, all right? And, you know, do I believe in the narrative? No. Does it matter for the market if I do believe it or not? No. So what's matter? The only thing which matters is what the market thinks. And if the market right now is buying into that narrative, which, you know, it's not only the debasement, that there is the industrial component thesis as well, you know, building up AI, building up semiconductors, building up solar panels, and you need silver and you need copper, or, you know, for palladium, well, you know, building up the energy of the future. So even in America now, it's going full on nuclear. So there are a lot of fundamental drivers. It's just that, you know, there will be something in the future which is going to break this momentum to the upside. And although the fundamental story will stay intact, we are still going to need a lot of copper. We're still going to need a lot of silver. You might find out that maybe those are mispriced, right? For instance, let's put it this way. I'm going to give you a simple example, which it doesn't mean that the market will crash, or these markets will crash, but it is some sort of a, you know how a bubble burst, right? Type of example. Let's say, and you might say, well, but that's stupid and it's never going to happen. Sure, I know. I'm just getting it to an extreme in order to, you know, lay down a concept, which is valid for silver, for copper, for many other different things, right? Let's think about this. We have something like, I don't know, silver, which is going up because solar panels and all the rest. Oh, all right, fine. Now, what happens if at a point silver gets so expensive that actually making a solar panel costs you a hell of a lot of money? And guess what? When you go out to the consumers to sell it out, they can't afford it. Therefore, they reject those higher prices. So what's going to happen is that you're going to have a lot of solar panels that you cannot sell because people don't have the money to spend on it. They can't afford it. What usually happens? Well, demand for solar panels goes down. Therefore, you don't produce any new solar panels. Therefore, you don't need what? You don't need more silver. So the industrial part or demand component of the equation goes down. And at that point, it might be, wait a minute. The market wakes up, well, we were thinking that the entirety of the surface of the Earth would be filled with solar panels. It's not like that because they're too expensive now. What am I holding this silver for if that's not the future we are going through, right? Now, again, I know it's very silly and it is very stupid, right? But it is just a concept, and it's basically how supply and demand imbalances are usually resolved. You get to a point where prices get so high that it's not more convenient to produce some stuff or to use those same materials to produce that type of thing or item or object, right? So that could be one thing, right? Doesn't mean it's going to happen now or tomorrow, but in the future, it could be one of the triggers which reverse the supply and demand story right here, right? Plus, you got many other things. It could be, imagine a lot of people having, silver spoons, silver forks, and all the rest. Usually it is something that you receive as a gift when you, in the past, I don't know about now, probably not now, but, your grandmothers, right? They might have a lot of those. They were used to be gifted when you were marrying, right? Or maybe you just inherit that, or whatever. There is a price when it's reached, it's going to bring more new supply onto the market, right? Because those people which are holding those physical silver are going to say, I'm not going to sell now because, why should I sell? It's going up and up and up every day. I'm rich on paper because, you can't spend that silver. You can't go into a grocery store, buying the old shop up and say, well, I'm going to pay with this silver spoon right here. My grandmother gifted me with that. I know it's worth a lot of money now. Yeah, sure. The shopkeeper will look at you like you're numb. But again, at a point, a lot of people will say, well, look, why is the price not moving anymore? Why it's not going up anymore? Oh, well, this week it came down, actually. Maybe all that physical silver I got, I waited, 20 years for it to see it going up. I'm not going to sit here and holding to it while price is going down. That's a lifetime opportunity to sell silver at these prices, right? So again, the bottom line is high prices are the cure for high prices, right? There will be a price that when we'll be hit, it's going to bring new supply online. And that's, again, another way by which you can resolve supply and demand imbalances, right? Now, let's instead move on to yields, and let's have a look at what yields they did throughout this week. Not a lot. Basically, what they did is going up, gapping up because of Greenland, because, well, look, the US is just become enemy number one of the world, right? They're threatening allies. They are saying they're going to invade another country. Sure. Then what? Then, of course, nothing. Because I think that was never the plan, right? So, a lot of talks. Wednesday, Trump comes to Davos, talks for an hour. He says that he's never going to use violence. It was never intended, although he points out if ever they would have to do it, they would be unstoppable. Well, it's always useful to remind that, not only to allies, but to enemies, right? Okay, I get it. Peace through strength. Yeah, it's new philosophy. I get it. All right. But, again, look, what were you expecting? Were you expecting that all of a sudden, in a matter of 1 month, after 70 years of alliance, we would be at war with the US? I'm talking on the European side here. And well, first of all, in order to be at war, you need an army. So again, they might look at you. And every time I hear people like President Macron, right, saying, well, we won't allow that. We won't let it happen. Yeah, sure. Okay, so for a minute, again, let's assume they do actually go in with the military, right? What do you do? What the EU does? We really and solemnly condemn this act. Yeah, sure. And we are going to do whatever we do, we can do to, reverse it, prevent it. And on the other side of the Atlantic, you're going to have someone answering you, yeah, you and what army? I'm like, those are just empty words, right? So nobody wanted that. And again, you might say, okay, but that doesn't change the fact that for now, the world might look at the US like an unreliable partner. Maybe, sure, and therefore asking a much higher yield for, in order to hold those US treasuries, that debt. All right, maybe. But, they gapped up and they spent the rest of the week coming back down. The long end, it's basically where it opened, so nothing changed. All the rest, the 10-year, it's kind of there. It's actually below where it opened, and it's much closer to where it closed the previous week. The 2-year is a bit higher, but again, it could be a story there where, we were expecting the Fed to keep on cutting. And again, it's always links to the rest of the video, right? The Fed probably won't cut because GDP is too good, because PCE is stable at 2.7. So maybe we have reflation. If we were kind of trying to be forward-looking and pricing this thing for the future, therefore seeing lower rates, now it looks like there is a story of growth and reflation. So we need to reverse that future pricing of lower rates and maybe a bit more stable rates. And it just so happened that the 2-year yield, it came back down into the range it was before, right? Same levels we were at around last August, September, October. We're still there, right? So it could be something like it, but surely it's not the rest of the world massively selling treasuries all at once in a coordinated effort, right? I mean, the futures, they just reflect the same thing. Now, why am I saying, look, I know sometimes when you do tell these, let's call it stories, opinions, I know that I might be carried away by, let's call it the heat of the moment, or sometimes you try to be particularly enthusiastic about something just to emphasize that that's a very key point that you're trying to make. But at the end of the day, I do it. I mean, I record these videos mainly for fun, right? And I'm not here to judge what other people's opinions might be. And of course, I'm no geopolitical or political analyst, so I'm not here to express, a judgment on your potential political idea. So, I know it's hard to separate the two, but I'm just talking markets, right? And, I know politics can be impactful for markets, but I do also think that you should have the right hierarchy in these. And what I'm trying to say is, you might say, well, okay, but which is the one influencing the other? Are markets influencing politics, or it is politics which influencing markets? Well, that depends. That's the thing. That depends. Like, for instance, people are now saying, well, all those talks about an aggressive acquisition of Greenland by the US immediately faded when, the administration looked at the yields and they saw that they were spiking, which would throw a dent in their capabilities of refinancing themselves or rolling off the debt that they got, which is massive. So they had to backpedal. Yeah, that could be one thing, right? That could be one thing. And I think, to some degree, I would assume that Scott Bessent wouldn't be happy if he sees that, and he might tap onto the president's shoulder saying, well, you know what? We escalated it a lot. Maybe we need to de-escalate that. Okay. But think about the other side of the equation. What if all the escalation and all the talks was just the usual? I mean, at this point, especially in Europe, I don't get how people yet at this point, after the first term and after 1 year of his second term, I don't get why people are not still understanding Trump's modus operandi. He comes at the table, right? He shoots higher just because he want to make sure he's going to gain something out of it, right? The usual good old saying, if you want to reach the tip of the trees, just aim to the moon, right? Just, set up higher bars, so even if you fail, you're still accomplishing something incredible, right? I think that's the same tactic of negotiation. So everything is communicated by hyperboles. At the end of the day, I would like to obtain, 10 out of this transaction. So when I come and sit at the table, I'm going to ask for, 50. So it looks like, yeah, I'm asking 50. I'm willing to get down to 10 just, because I want to be a good guy. You're my friend and all the rest. Yeah, but 10 was what I was aiming for since the start. It's just that if I was asking for 10, maybe you would have allowed me 6 or 7. Wouldn't have gotten a 10, right? So I think that's a lot. That's a lot of that component, which sends the markets crazy sometimes, as we can see in here. But at the end of the day, a lot of that is just noise. For instance, throughout the week, while everything was going on, you could have read something like this. So EU. Now, first of all, look at the EU when they talk about the anti-coercion mechanism, selling treasuries, imposing tariffs, preventing the U.S. companies to access European markets. All right, so okay, let's have a look. This is the composition of what the EU investors are holding when it comes down to US assets. And as you can see, the majority of it is equities, all right? Now, sure, they got a good amount of treasuries, 2 trillions, which, is almost 20% of the total. So if for any reason because I'm European, obviously, but we would decide to dump all at once, all those treasuries, would we cause a damage to the United States? Yeah, sure, because probably you would see the yield on the 10-year spiking maybe to 8, 9, 10%, maybe, okay. But, we would be better off or worse off? Yeah, we can cause them a huge damage, and in the process, shooting ourselves into the foot, into the knee, into the leg, all at the same time. Because whether you like it or not, the world is still running on treasuries, and you might hate President Trump, you might hate the one before him, with Biden, right? You might hate the US as a whole. Doesn't change the fact that the world, it's collateralized on US treasuries. And if you don't have US treasuries, you can't access the global markets, not only financially, but even on a commercial base, right? And again, we get back to, well, we could do just what the Chinese do. They basically priced oil in yuan. No, they're not. No, they're not. They're saying it, but at the end of the day, the transaction still happens in dollars because there is still not the infrastructure which would allow all people across the globe to be able to transact using those 2 different currencies and having some sort of a middleman like the USD is doing for now in the euro-dollar system, allowing them to communicate and to exchange flows of capitals in a common denomination. There's nothing like that yet. And the US dollar system, it's still the only viable alternative. And sure, there are attempts to destroy it or to replace it, but, the BRICS are talking since 15 years ago that we are going to meet up to announce what we're going to do next year. Yeah, they're doing the same 15 years. Sure, they accomplished a few things. Why not? Joint ventures, agreements, and all the rest. But they're far from replacing the system, I think. So, would be European better off or better worse if they dump US treasuries? I would say better worse or worse off, right? Yeah, also because you can't say better worse, right? Secondly, don't discard the fact that we bought a lot of these treasuries when rates were at 0 or 0.5, 1%. So if you liquidate all of them, now that rates are at 3.5, 4, 4.5%, you're gonna sell those at a massive discount. And you know what it is in a nutshell? It is like, look, I have been conducting an economy, producing stuff, and then exporting the products to the US. They paid me XYZ, and I decided to store that capital, that money, into US treasuries. So this is basically my savings account, and it just so happened, if I keep it the way it is, I can value it and marking it to market at the nominal and face value, right? If I have to market and sell it out right now, I'm basically gonna sell out my entire savings account, taking what? 40, 50, 60% haircut on my savings as a nation? It took me decades to accumulate them. So again, you might say, yeah, we're gonna send those treasury yields spiking. Doesn't matter if in the process we have to basically destroy the entirety of the European economy, but you know, at least nobody gets the cake. If you can't have it, or I won't have it, you can't have it too. What type of logic is that, right? And then, you know, look at that. That was incredible. So now look, Greenland, Denmark, all over Greenland. We are going to sell all our treasuries. Yeah, sure. First of all, who cares? 9 billion. You are already at the lowest level of the recent history. So 9 billion? So what? Who cares? Right? You can fire sell 9 billion of US treasuries, and the market is so deep that you wouldn't move the needle like it would be meaningless. Right? And look, what else? Oh, that was crazy. Okay, so Danish pension funds, Academica, right, threatening to exit all treasuries by the end of the month. Now, look, that pension funds, 100 million in treasuries. Sell it tomorrow. The market won't even move. Who cares? There are financial firms, portfolio managers, money managers all across the globe, which on their own, individually, own more than double or triple what these pension funds in Denmark actually hold when it comes down to US treasuries. So these, plus again, when it comes down to selling US treasuries, the European as a whole, well, it can only work if all the treasuries would be held by the ECB. Right? It just so happened that it's not like that. A lot of treasuries are held by banks, hedge funds, pension funds, private individual and single investors. So it's not like the European Council is going to wake up, sell all those treasuries now. But so, I mean, how should we give a call to basically every single individual owner of US treasuries in Europe, and we, for some reason, expect them to be willing to do what we tell them to do? No, because you know what? It might be that there is another pension fund which is not involved politically or emotionally with this whole matter, and they're going to say, or maybe a bank. The bank example is even better, right? They're going to tell you, you know what, respectively say, fuck you, I'm making free money here, why would I stop? And again, because of what? Because a bank, it collects money from who? From the depositors. So those money are free for the bank. It pays an interest which is neglectable. And then what the bank does with money which are not its own, they buy US treasuries, they collect that 2, 3, 4% yield with no risk, because those are not money out of the bank's pocket. They get the yield, they return to the customer or the depositor on a checking account. It could be, 0.2, 0.3% annualized interest rate, and they pocket a huge spread. So if you think you're going to go there and tell those people that they need to sell those treasuries just because the ECB or, the European Council is saying so, they're going to say, fuck you. I mean, unless you provide me with an alternative which makes me at least the same amount of money with the same or even less amount of risk, I'm not gonna do it. And if you think you can force me to do it, watch your capital markets, because I'm a bank, but I don't have these single subsidy. How do you call it? Fuck, I just forgot, and it completely wrecked my train of thought. But anyway, that a bank can have different headquarters, right? Or branches, right? So I mean, if regulations might change in this part of the world, you know what? Say goodbye to your capitals, because I'm gonna move all of them in the other branch, which is maybe in another legislation, another jurisdiction. So you're fucked, because you're gonna suffer a lot of capital outflows, and that would bring you to what? Deflation, right? And the entire economy crumbles. You're gonna have people threatening to burn down the European Parliament if you do so. And by the way, for the sake of par condicio, it would be the same in the US, most likely, if something like that would happen, which is why they define it a nuclear weapon of mutual destruction, right? Well, the US government, they kept on selling treasuries, obviously. So, allegedly, if they sell it, someone actually bought it. So, who bought it? Look at that. No matter what the Europeans are saying, it looks like everyone still wants and keep on buying US treasuries for a lot of reasons, a few of which we have just discussed, right? So I know a pretty long part on yields and treasuries, and a little bit of a catch up on what's going on or what went on with geopolitics and all the rest. But, I think it's not bad to have it, all right? And after that, let's transition, as usual, into the equity markets. Now, the equity market was particularly quick to analyze. It ties in a little bit with what happened as for geopolitics and tariffs and all the rest. So gap down on Monday, the market kept on dropping, knee-jerk reaction because of, trade war, tariffs and all the rest. Then, of course, you get to Wednesday, right? Trump says we're never going to use violence. It was never intended. We can actually work out a framework over Greenland. I just spoke with Rutte from NATO, and he told me that it's possible to come up with an agreement with all the NATO nations. And sure, the market goes immediately high, because he said, in the light of all of that, we are not going to impose tariffs on anyone. And so the market rose back higher. And look, we basically feel the gap on NQ. We start to feel the gap on ES, same on the Dow, basically. And we kept on drifting higher, right? For the rest of the week. At the end of the day, Thursday, a little bit of volatility intraday on Thursday. Friday, the market was down in the morning, but, massively up in the afternoon for the New York session. And look, this is a 30-minute chart, right? But let's go to an hourly, maybe. Yeah, okay. Look at what happened. So you see the gap down. Now, all of them feel the gap and then some. But look at the last 2 days of the week, right? And what you see here might be something which comes out to be relevant. It could be. So you see ES futures closing down the week with a lower highs on an hourly time frame. The NASDAQ actually went higher. And obviously, the Dow started from this point out to come a bit lower. So I know it's just an hourly chart. You would prefer to see it on a 4-hour chart, on a daily chart, and all the rest. But if it keeps on going like this, I'm saying there is at least a little bit of hope that we get back to that framework where the Nasdaq, it's leading to the upside. The S&P, it's following, and the Dow, I mean, it's not crashing, but it's getting very little attention compared to, you know, to this one in the middle, which would align with another rotation, this time back into the Mach 7, technology, communications, and all the rest. I'm not saying we are there yet, because this is an hourly time frame, but, you know, and even because, you know, the 4 hour, there was a huge rejection in here. So it's still early, but it could be the beginning of something, right? Other than that, I mean, at the end of the day, if you check this one, and if you look at the different sectors, you've seen that financials have been hit, technology is staying relatively flat, and still energy and materials going up. Even healthcare actually rebounded a little bit this week, but overall, a lot of what moved the market came in from here. Now, I've seen, especially Intel had a little bit of, you know, the earnings were fine, but the guidance wasn't spectacular, so to speak. Just, you know, long story short, Netflix dropped on earnings announcement, and just remember, next week, we gonna have not only FOMC, but on Wednesday, same day, we're gonna have these. Look, Meta, Tesla, and Microsoft all announcing earnings. Now, sure, it is after the close, so, you know, you might see the effects, especially in the following day, but, you know, pay attention to these. These could be a huge market mover. And on Thursday, what do we have? We got Apple and, I thought, no, we don't have Google, I guess. No, maybe Alphabet is next week. Who knows? But, you know, a few of the Mach 7, yeah, next week we're going to see Google reporting. A few of the Mach 7 will start to report earnings this week. So that could be a huge market mover, right? If you zoom out, at the end of the day, you see that, as we were discussing, a little bit of a better close from NQ futures relatively to ES futures, and the Dow still in this range. And, you know, going at this point, it looks like we are going a little bit for, you know, few lower highs in here, which, I mean, you could say the same for this one right here. Although, oh, well, if you look at it like that, it looks like the Nasdaq, it's the one which is trying to break out of this recent downtrend. So, oh, we'll see. Huge pullback in the Russell. And everyone is scratching their heads. What could this be? Well, you know, I think, very simply put, when a market goes up like this, at a point, you need to expect something like this coming. So, you know, is it something major? Well, no, I mean, I don't think we broke any type of relevant level. I don't think one would be here. Or maybe if you go on a 4-hour chart. Yeah, pretty much. This one, basically. Yeah, one would be here preliminarily. So up until the point we're above it, that could be still good for a bounce. We will see. The thing is that, you know, if you lose this area, let's call it 2007, 2600, you might have another 100-point drop very easily. So a little bit of a much pronounced type of pullback. But, you know, let's believe it when you see it. Although, you know, there is a little bit of a controversy in the strength of the Russell recently. And, I mean, we could just assess it right away, right? Which is this one. So look, if you check the Russell 2000 companies which reported negative earnings per share, they are the one which are appreciating the most. While the Russell 2000 companies with positive earnings per share, they're falling behind. So what does it tell you about, you know, overall, this up move in the Russell. It's led by what? Companies which are not growing earnings. So fundamentally, it's not sustainable. So is it a little bit of a speculative rush instead of genuinely and fundamentally driven type of upside? Maybe, who knows? If that's the case, at a point, this entire relative strength will be undone. And, things like NASDAQ and the S&P will get back into the leading seat, and the Russell will get back to what it is. And, that would be, although I think, again, that would be tied in with the narrative about reflation or not reflation. But, it's gonna take a while to see how it unfolds itself. But for now, let's keep it in the back of your mind. Same thing here on the ETFs. As you can see, huge drop down on an open Monday. And, you see that green moving average, that will be I think that's the 55 exponential. You could have used the 50 simple moving average on a daily time frame. Still kind of the same dynamic. We broke below it and closed below it. But then immediately the following day, we rallied and reclaimed it immediately. Kind of like what happened in here, right? So again, with these moving averages, they are not lines in the sand. It's more of a guidance. So, if you want to confirm a moving average being lost, just wait for it to be broken, retested, and rejecting now price into the anticipated direction. Otherwise, it's just, I think it is just an algo thing, right? There are a lot of CTAs which are programmed to do these things, which is basically hunting people's stops, because a lot of people will look at these and saying, you know what, the market closed below that moving average XYZ, I need to sell. Yeah, you sell. They're picking it up. They're lifting that offer, and the very next day the market runs up. And especially, don't do that if the drop it's coming off of a news-driven event. Just let it settle, wait out a little bit, and see how it shapes up. It's the usual knee-jerk reaction, right? Which, has it ever end up well for anyone? No, I think not, right? Now, after that, just briefly before we stop, this is the current situation as for the sentiment, and looks like we are particularly in a good mood, all right, for now. And this is the cash levels. So it looks like the market, or in this case that would be fund managers, they are almost fully allocated now, which again might be because when you have something which it is a catalyst for a potential pullback, you don't see an immediate type of support, because a lot of the dry powder that these fund managers would have, it's actually already depleted. But, the good news is that even if they couldn't, right, you got someone else stepping in and buying the dip. Who might it be? Retailers, right? So, individual investors, so to speak. So again, we keep on looking at a dynamic where the buy the dip mentality, it's still working, right? Why shouldn't? If you have been trained to have this Pavlovian reflex, as where every single time the market drops more than 2, 3, 4%, well, just buy it. No matter what, someone will intervene. The president will reverse course. The Fed will intervene, and they're going to run the markets higher. So, it's like you do it automatically. Plus, the usual giant mindless robots, passive investing, all these passive funds, which, they provide an infinite bid, allegedly, or I guess they will, up until the point, something like unemployment will reach specific levels. And at that point, maybe even ETFs buyers, they are going to, switch from being net buyers to net sellers, but that's a topic for another time, right? What we had was these again, so it looks like even breadth is improving. 63% of the S&P stocks are now outperforming the index. So, That's an improvement in my view. It's a market which is not narrowed down to 5, 7, 10 stocks, but it looks like a lot of the other stocks participating in the index are actually performing good. It is kind of a record, right? So, although we had this major scare for now, it looks like the market quickly absorbed that and just looked through it and said, well, that was nothing. If not, another buying opportunity. So we keep on maintaining that bullish bias, or at least, that's what the surveys or the data are actually showing. Might be, again, you never know. We have another catalyst. Again, getting back to the Bank of Japan, the yen finally, popping up. Might be, if it keeps on going, it will trigger an unwind in a yen carry trade. And although people are willing to buy the dip, the sentiment is good. If we have a liquidity issue, that will all go out of the window. Who knows, right? There are infinite risks out there, but, and you can't forecast them all. And usually those which are going to get the market are those that were not forecasted, right? So, what else? Well, again, just to reiterate the fact that we could see a bit more of improving in the breadth. So this is the RSP, so equal weighted S&P 500 ETF. And you see that the short interest on that, it's particularly high. Now, what does it mean? Look, either two things. You can read it two ways, in my view. Either people are betting that we are going to get back to the usual playbook where the MAC 7 leads the charge and all the rest of the index, it's relatively flat or vastly underperforming. And therefore, the RSP might stay stable or even drop a little bit. Or, if we keep on seeing a breadth which is improving and the overall tone of the market being good overall, with even more and more stocks actually starting to rally and join, the ones which are already leading, that would bring to what? Well, a lot of shorts. If the market keeps on going higher, the equal weighted, but these shorts will need to close down. And what does it mean? It means that more people will have to buy, because they're closing shorts, right? They will have to buy back ATF's shares on the equal weighted index, which will propel even higher the equal weighted index, because every share of their ATFs will need to buy a lot of many different stocks in the index, not based on market capitalization, but weighting that out equally, which again should improve the breadth even more. Will it happen? We don't know yet. It's just to say that, the stage it's set up to get to a decision point, I think, right? So we'll see. We already went through this. What else? Oh, look, we have been discussing that 2025 might end up being a very volatile week. Now, in order to kind of cool off things a bit and just trying to look at things objectively, when you see the market down, I'm talking about the S&P now, right? Look, 5% or worse, they occurred 94% of the years getting back to 1928. We're talking a century. 63% of the times throughout the entirety of the year, you might see a 10% of war or worse correction. So overall, 5 to 10% corrections on average, they are a buying opportunity because they happened basically, 63% of the times. And at the end of the day, the market over the long run kept on going higher. Excluding those periods like, 68 to the late 70s or the early 2000s to 2012, 11, kind of like that. But overall, on average, the market kept on going higher. So don't be scared if the market it's down 2-3% last week. It is just normal, right? So keep your cool. Now, when we talk about 20% or worse, oh, well, that happens 1 in 4 times every single year. So, it's not something that you see very often. And again, do you remember these talks about people going on YouTube, selling fears like, the market will be down 40, 50%. 40% or worse, again, 1 century, in a year happens 6% of the time. 50% or worse, we're talking GFC now, 2% of the time. So those are very tail-end risks, right? And I know that it's easy for people to say, yeah, well, sure, but what if it happens and it turns out that we are right in that 2% window this time around? So be it. I mean, the thing is that even, look, let's get back to our chart just to prove this concept, right? Let's take the SPX and then we close it down. Look, let's get back in time, right? And let's get back to a period which was particularly bad, right? 2008, all right? Okay. Now, from peak to trough, the market was down. At the end of the day, what? Okay, 57, almost 58%. Okay. But, look, before getting to there, right? Look what happens, right? The market starts to come down, right? There is this preliminary support in here, right? And we break it. So first of all, we break here. So, you might say, well, okay, the usual logic is a temporary break. We're going to run back higher once again. It's no time. Just wait it out. Problem is, the market tried to get back higher and it fails. And what happens next? It goes down again and it breaks this low too. And it's never able to get back above it and reclaiming it. And then, you get into May 2008 and it keeps on drifting. And then finally, you get to September, Lehman Brothers and all the rest. But just to show you that, look, initially the market goes down, right? And you see how it's slowly breaking level of support, failing to reclaim them and confirming them as a resistance. And again, it's drifting down. So look, at the end of the day, right, conceptually, what if, all in all, you manage to massively de-risk while the market is down 10%? Or even in here, right? Look, even in here, right? The market breaks this area, right? And it's never able to reclaim it. So as soon as you see this type of rounded distribution, the market retests back into it in here, or even in here, right? And at that point, you would be down from the peak, like what? 20%. Now, I'm not going to sit here and saying that everyone would wake up every single morning saying, oh, well, I really wish I'm going to be down 20% this year on my investments. No, but what I'm saying is that you have a lot of time and situations where you can assess what the market is doing and deciding what type of exposure you want to have. That doesn't mean that your entire portfolio is going to be down 57% if you have a little bit of a brain, right? Because you would likely de-risk in here, then you would de-risk in here again, then you would de-risk in here again. So maybe when we get back to the very acute phase of the crisis, at that point, your exposure, instead of being 100%, it's maybe 30%. So you're not suffering, the entirety of the drawdown, but you allegedly took profits already on many other different things, and you might had the time to, I don't know, to buy protections, to buy another asset which is going up when the stock market is going down. It could be treasuries, it could be whatever, right? You pick that one. So again, just because you see something like that, it doesn't mean that you're fucked. Even if we have these 6% or 2% type of iterations, right? So that's where I'm going to leave it. I know it's been a long video, but, at least we didn't talk a lot about the economic calendars and fundamentals, but we spent a lot of times on the charts, I do believe. So, hopefully you like it. Probably a lot of people won't watch it because they are just scared. As soon as they look at the length, they're not going to watch it. But I don't care. I say what I want to say. If you don't care, skip ahead, move forward, or don't watch it. Look, if I wanted to do it for the views and for the money, it would be a completely different format. And quite honestly, I don't fucking care about YouTube revenues. Fuck it, right? That being said, have a nice rest of your weekend, and let's get ready for another interesting week next week in markets. Hope you're fine and well, and as usual, be nice and be cool. Knees out. Mm-hmm. Mm-hmm. Mm-hmm.